Your business is a living, breathing organism with many moving parts. A business owner has to be able to track how much money he is spending as well as how much money he is bringing in to the company. And that's where the profit and loss comes into the picture. Hi, I'm Ricky Cool from Cool Bookkeeping, and I'm here today to help you understand your profit and loss. Let's get started. Your business has many things that you'll need to track. First, we have your assets or your major purchases. These would be things like your building, your equipment, vehicles you may own, or tools that you've purchased to be able to run your business. You may also have liabilities. These would be things like credit cards, long-term debt, tax withholdings, either sales tax or payroll tax, short-term debt, or maybe promissory notes. This is money that you owe to other people. You have operating expenses such as rent, utility bills, office supplies. You have your costs of goods or products that you're using to make money for your business. That might be your inventory, job materials, raw materials, serving supplies, cups, plates, napkins if you're a restaurant, or items that you purchased for resale if you're running a retail organization. And then you have your income, the best part. How much did you bring in through sales? How much did you bring in through service income, tuition, donation? At the end of the tax year, your CPA is going to want to know the answers to these questions. How much did you make and how much did you spend? That's where the profit and loss comes into the picture. Let's take a look at what the profit and loss can tell us. So first of all, there are two major financial statements that most businesses use. The first is the profit and loss. If you are in the nonprofit world, this is called the Statement of Activities. It's essentially the same report with a few of the headlines or the captions changed. On the profit and loss, we would list income for a given period of time, this year to date, this month, etc. The costs of goods sold. So for the items that we did resale, what did they cost us to purchase? And then we have our operating expenses, the rent, the fuel, the utilities, and things that we have to pay in order to be able to run a business. The second statement is the balance sheet, or in the nonprofit world, the statement of financial position. This would be things like your assets. How much money is in your bank account right now? It might also be the equipment that you own or any property or buildings that you own. Your liabilities, this is money that you either owe to other people or that you're holding and waiting to send in, sales tax, for example. And then you have the equity portion of your balance sheet. If we take our assets, the things that we own and have, subtract the liabilities, the things that we owe to other people, you will end up with equity. And the higher amount of equity you have, the healthier your business generally is. We're not going to talk today about the balance sheet. We'll do that on another video. Today we're going to talk about the profit and loss. It's going to answer a major question that every business needs to know. How much money did we make or did we lose this month? Whereas the balance sheet is going to tell us how healthy or how weak is our financial position of our business. The banker is generally interested in the balance sheet, although he'll want to see profit and loss as well. So let's see what goes on to a profit and loss statement or a statement of activities. Remember, it's going to answer the question, how did we bring in money? Where did we spend money? And it's going to let us start to get some insight into where we can make changes. Let's take a look at Craig's Design and Landscape, which is a fictitious company. First, we have our income section. The top part of every profit and loss statement is the income section. And in the income section, we're breaking down our income into categories. In Craig's case, we're keeping it simple here. It's just sales and services. Yours may be simpler than this one. You may just have a category that says income. As a business owner, you get to decide how detailed you want your profit and loss to be. But Craig wants to know how much he makes in sales versus how much he makes in services. If we add these two figures together, we get his total income. However, he has some costs associated with these sales and services that we have to take back out of the picture. So in order to get the gross profit, we take his total income subtract the cost of goods sold, and we come up with $955.25. But now he didn't get to keep all of that. Remember, he has operating expenses. So in his case, he has rent of $700 a month. He has to pay utilities, fuel, and payroll. So his expenses for the month came up to $1,100. Well, he only brought in $955.25, leaving him a net loss for the month of $144.75. So now Craig has some decisions he needs to make. How am I going to cut my costs, or do I need to raise my prices? That's where this item right here comes into play, and I want to talk about cost of goods sold quickly. Here's a logical question. Why are COGS, or cost of goods sold, in the income side of the profit and loss? And you'll notice this is an expense that we've put up here with income. Why not put them down here with expenses? The answer to that question is costs of goods sold are directly connected to sales. They increase or decrease proportional to the volume of sales. In other words, if I were running an ice cream shop, I would have my costs of goods sold increase if my volume increased. The more scoops of ice cream that I put out, the more cups and plates and napkins that I'm going to have to purchase, and the more ice cream that I'm going to have to purchase. So cost of goods sold goes up or down directly proportionate to the amount of sales or services, whereas the operating expenses do not go up or down proportionate, or at least as much. They're more than likely going to increase or decrease to some degree, but they're not directly tied. So for example, in the case if this were an ice cream store, if you sold $100 worth of ice cream or $1,000 worth of ice cream, your rent would not change. It's going to stay the same. In all likelihood, your utilities are not going to change. I know you may say, well, the door will open and close more, the freezer will be open more frequently, maybe my utility bills are going to go up to $175. It's not directly proportionate to the items that you're selling. In Craig's case here, you could make the argument that fuel here needs to go up into the cost of goods sold because a large portion of his income comes from services. It might be on-site services. So fuel technically could be moved up to the costs of goods sold. Some companies track it this way, some do not. It's really a judgment call on your part. But for the most part, his fuel will not go up and down directly proportionate to the volume of sales or to the dollar amount of the sales. So in this case, when I look at Craig's cost of goods sold compared to his operating expenses, they're approximately the same. He may be able to find cheaper rent, but he's not going to be able to do an awful lot about the items down here. He could lay off an employee. One thing that sticks out to me is that we have $1,241.13 in sales. That's probably got a huge impact on this line right here, the cost of goods sold. He purchased something in order to resell it. Well, he brought in $1,241.13, whereas when he sold them, he had spent $1,100 to purchase the items that he actually sold. So he only made $141.13 in profit. So this is where cost of goods sold is going to give you some very valuable information. In Craig's case, he probably will need to either increase his prices or he's got to find a better supplier so that he has a better handle on controlling his costs here. One more thing I want to do before we go today is take an actual look at a profit and loss statement. This is exactly what they'll look like if you use QuickBooks. And so I just wanted to give you exposure to that. In the top, you have the income. And in Craig's case, Craig's Design and Landscape, he breaks his income down into multiple categories here. He provides pest control services and other services. But then down here on his expenses, he has advertising, fuel, equipment rental, and then job materials. Now, could job materials be put up in costs of goods sold? Absolutely. But in Craig's case, more than likely, he's referring to sand and gravel or items that he stocks in his inventory or something of that nature. And so we go all the way down. We do have other expenses or miscellaneous expenses down here. There are a few expense categories. It's not very important for us to get into on the overview part of it, but interest income, for example, might show up down here as an other income. And in Craig's case, he ended up clearing the month with $1,642.46. So he's in better shape than what I showed you he was. One thing I did want to show you is that on any of these expenses in QuickBooks, if you come over here to the dollar sign, then you'll notice that it hyperlinks when you roll over the top of it. If Craig looks at this and says, wait a minute, you said $112 for your equipment rental. Where did that come from? Well, if we click this here, it will pull up a drill down report that will show us the individual transactions that make up this expense. In this case, it was from Ellis Equipment Rental. And if we had been doing this correctly, we could go all the way down to the transaction itself, and we would be able to pull up a copy of the receipt, which is another video that I'll be making, how to attach receipts to your individual transactions so that you have them when you need them. So I hope that's been helpful for you. Again, my name is Ricky Cool, and I'd love to hear what you have to say on this subject. Do you need more information about what a profit and loss is telling you? Do you have questions? Drop those in the comment box below. Also, remember to subscribe to my channel, as I'll be posting videos here on a regular basis to help you make the most of your business finance and your reporting to get the most out of it. Bye-bye for now.